Hi everyone. So I kind of alluded to this in a prior video. Just a very quick summary. The video is about pensions. If you like the content, please like, comment, subscribe. And basically, yes. So state pension, assuming you've made the contributions, national insurance in the UK to qualify for this. Most people are going to get. At the moment, I think it's around 12,000 per year, so not a huge amount to live off, and you can't get that until you're 67. So that's kind of the we'll call that the benchmark for that. And then obviously, if you've got a workplace pension, you can start drawing money from that. There's you can only take 25% tax free, and obviously what you'd have to be careful of is, I suppose, once you're receiving both, if you are over the tax free allowance, then you'll start paying tax on it. So those are the kind of the two things you get, and obviously with workplace pension you're probably contributing 5% yourself, employer 3%, and that's assuming obviously you qualify for it, and you haven't opted out, etc. So not potentially huge amounts, but also what's on your side, if you, I suppose, started work when it was already in place, is what's on your side is time. So I suppose similarly to state pension, but it's because you're paying in for a very long time, even at quite modest market returns of 5%, it would be quite a substantial amount by the time you retire. Obviously that would vary on maybe the provider, because I think some give you options about what you want to invest the pension in, and obviously generally the riskier ones might have higher rewards, but also that have to be something you'd look into, kind of what you're happy with, because remember, this isn't financial advice. But what's going to talk about is there are different types of account that might help people who kind of maybe approaching retirement age, kind of bridge the gap, and those are there's like a self-invested personal pension, and obviously that works very similarly to the workplace pension, but I suppose you have a little bit more control because you can set up yourself, manage it, and then you can kind of just put your own contributions in there, and I believe there you can get the tax back on it that way. You can also pay into workplace pension voluntarily, kind of on top of the 5%, and get the tax back on that. And then another one is basically with a lifetime ISA, you can also